What's up, everyone? It's Caddy with MoneyVest. So thank you so much for joining for our morning live stream on inflation. So CPI numbers are going to be scheduled to come out in less than an hour. So in about 45 minutes, we're going to get the headline inflation and core CPI over in the US for the month of December 2023. So for last month, because it's a lagging indicator, if you all can hear me and see me, just give me a thumbs up in the chat. I just want to make sure the audio and the video is working well, so there are no technical difficulties. Again, just give me a thumbs up in the chat. And we're trying to get to at least 1,000 people watching today, okay? So share this live stream with your friends, with your family members. If you have WhatsApp groups, Discord groups, just share this so that more and more people can participate. And of course, we can get a good data set when it comes to the poll that we have going on right now. So the consensus, again, the expectations are for headline inflation to be at around let me just take a quick look. So it's around 3.8%. And of course, for core inflation to be a little bit lower. So let me just quickly pull that up. Again, if you guys can see me, hear me, just give me a thumbs up. Just want to make sure the audio and the video is working well. So all systems are functional, perfect. And make sure that you do also share this live stream with everyone so that they can join us. And of course, we can get to over 1,000 votes on our poll right now. So core CPI expectations are 3.8%. So that is going to be that consensus at the moment. And headline is going to be 3.2 on a year-over-year basis. So that is going to be that CPI consensus for December 2023. So once again, thank you so much for joining. Really appreciate all of you. 2023 was an amazing year with respect to the metrics that we had for YouTube. Over 47 million impressions, 4 million views, over 438,000 watch time hours, and about 18,000 comments and over 250,000 likes on the channel. So I really do appreciate each and every one of you. And we're hoping to kind of double all those numbers into 2024. So it's going to, of course, take a lot of work, a lot of effort, a lot of support from all of you. So again, thank you so much for joining. So this right here is going to be the consensus when it comes to the CPI numbers. By the way, I want to actually spend at least 20 minutes. The first 20 minutes I want to spend going over any questions related to individual stocks, markets, or macros. So if you have any questions related to those three topics, whether it's macroeconomics, recession, inflation, interest rates, whatever, or individual stocks, or even with respect to any ETFs or sectors, I'm happy to go over that first. And then we're going to quickly switch gears to inflation at around 8:15 a.m. Eastern. So 15 minutes prior to inflation numbers coming out, I'm going to go over some very important metrics. I'm going to go over some statistics. We're going to talk a little bit about inflation, what the expectations are, and of course, what things to watch and how the markets might react to the inflation numbers. So the first 20 minutes, basically the first 18 minutes, we'll call it around 8:10 a.m. Eastern. The first 18 minutes, I want to focus on any questions that you may have. So again, the floor is open. Let me know if there's any particular markets or economics or stocks you want me to go over. So how are you doing? How's the weather in your place? The weather's good. It's been pretty chill, pretty cool down over here in Dubai, and it's okay. Like, obviously it doesn't get as cold as anywhere else in the world, but it is still a pretty chill temperature here. I would much rather have a little bit colder temperature than it be hot. So this is probably the best time to be in the UAE. Of course, in the summertime it gets way too hot very, very quickly, and it's almost unbearable for me. Like, I start sweating fairly quickly. So Milan says we need to get a life. Yeah, I was just that was a very, very sort of just wanted to roast you guys a little bit. So of course I do that in all good fun and in a bit of a teasing way, because again, that's a lot of hours you guys have spent collectively, right? 437,000 hours spent collectively, which is close to 50 years. And we're looking to double that number to 100 years this year in 2024. So that's going to be close to 900,000 hours collectively that we could spend on my content. So that's going to be the goal for 2024. So, okay, let's take a look. So what is my view on Bitcoin ETF? So yes, that is a pretty big catalyst. So something that we can definitely discuss first. So SEC approves the first spot Bitcoin ETFs in boost to crypto advocates. The US SEC Commission has approved the first spot Bitcoin ETFs in the watershed moment that cryptocurrency enthusiasts are betting will draw new retail and institutional investors into the market. And there's been 11 ETFs that have been cleared with sponsors ranging from established players such as Fidelity and Invesco to digitally focused newcomers, including Grayscale and ARK Invest as well. And the first funds which trade on exchanges like stocks and enjoy special tax treatment in the US are expected to start trading as soon as Thursday. So today, Thursday morning, when BlackRock will be ringing the opening bell at NASDAQ to promote its iShares Bitcoin Trust as well. Now, while spot Bitcoin ETF have been available in other markets, the US approvals are expected to usher in a new era for the most popular and liquid crypto token. It's a huge milestone, of course, and it's a recognition of Bitcoin being a large-scale traditional investment, and we're opening the doors to Wall Street as well. These right here, one of our members, shout out to Artsy, posting for all the 11 tickers for today. BlackRock, of course, Grayscale Bitcoin Trust, we got VanEck, we got ARK, which is going to be ARKB, FBTC, that's Fidelity's Bitcoin Trust ETF, and then, of course, we got Invesco Galaxy, Hashdex, we got Franklin, Valkyrie, and again, a couple more, Bitwise and WisdomTree also launching their ETFs. But of course, BlackRock and Fidelity and VanEck are three of the most reputable issuers when it comes to exchange-traded funds. ARK, you can make the call for that. Grayscale, of course, has been around, focused on Bitcoin for some time, but this is going to be a spot Bitcoin ETF, so it's going to trade on the basis of the price itself. It's going to have actual Bitcoin in the underlying ETF as opposed to being constructed on the back of futures and options. So again, very, very milestone Memorial Day here for Bitcoin, and right now at the moment, Bitcoin is pushing higher, so a little bit up to 1.5%, so almost at 47,400. It's kind of approaching a big resistance at 48 to 51,000. So that is something to keep in mind. And Ethereum here also already starting to see a big breakout, up over 2.7% to as much as 26.55. And the next target is going to be 35.40. So, obviously this is going to create a lot of momentum, a lot of sentiment, optimism around Bitcoin and Ethereum and crypto in general. So obviously this is going to be a little bit of a bullish catalyst for the entire crypto sector at the moment. Are you going to buy more INDA, or you're just going to keep buying individual Indian stocks, Mr. Caddy? So I'm going to be buying individual Indian stocks. So I did send out some alerts earlier, I think this week or last week, that I picked up some more stocks in India, and I do believe that the market's very, very underrated. In other words, it's an emerging market that has a lot of growth potential in the coming years. In fact, over the next decade, if the Indian rupee kind of stabilizes against the US dollar, then that is on a currency adjusted basis. Also, there's a lot of potential because over the last 40, 50 years, what we have seen is the INR, which is the Indian rupee, kind of depreciate against the US dollar. So even if Indian stocks performed well, the depreciation against the dollar has made the returns maybe not as comparable to the US markets. But because the next 10 years, in my expectation, at least in my opinion, there is possibility that the US dollar somewhat stabilizes against the Indian rupee. There is possibility for both a stock appreciation in that growing emerging market, as well as the foreign exchange is not going to play a bigger role as it has over the last 40, 50 years. In other words, we're not going to see that returns kind of evaporate on the back of currency depreciation if that stabilizes, in my opinion. So that's why I think India, one of the most, potentially the most growing emerging market here in the Southeast Asia and emerging market in general. So gold, please, is it time to buy Tesla? So Locke, I did a video on Tesla. Definitely do check that out. It's in a downtrend. Technically speaking, it's making lower highs and lower lows. But my fundamental intrinsic value, of course, sits in the 140s, 150s. So for me, it's not really a buy at these prices, but I'm still selling options. I'm still selling calls, which are, again, doing really well. I mean, Tesla calls premiums are really high because implied volatility is so high. And as a result, we'll continue to do that over the coming weeks. We'll see, of course, how Tesla trades in the coming weeks, of course, after inflation and the earnings that are coming out later this month. So David, my Christmas Santa list was extra expensive this year. I think CPI is coming in hot. So yeah, I mean, we'll see what ends up happening. Of course, make sure to participate in the poll. We've got almost 150 votes right now, and the consensus is pretty split. It's 33, 34, 34. So it's kind of crazy. We've never seen this before where it is about as split as it can be when it comes to the expectations for CPI. So again, core CPI, we've got above, at, and below at around 3.8. That's the number. What do you expect? What do you think? Are we going to see hotter or more softer inflation print or at consensus? Let us know in the comments, and also do participate in the poll as well. All right, CPI in July 2023 was 3%, and now it's expected to be 3.2% year over year. Why the sentiment has changed significantly in the last 33 months as it's not going down. So if we come over to overall inflation, if we come over to the charts over here, And let's just go over 12 months, 20 years ago. So if we zoom in a little bit where we are, 3.1%, and this is exactly where we were back in 2021. We kind of went from 2.6 to 4.2, so that was a pretty big jump. We kind of skipped past that 3% range back in 2021. The idea, of course, is for us to stabilize and come down to 2%, right? That's the focus from the Federal Reserve, and that's just the rate of increase in prices in general is 2%. And you can see that for the longest time, we've kind of been between 0 and 5%. For some times, we've gone up to 4%, then we came back down to somewhat of deflation at below 0%, then we kind of stabilized at around 2%. And for the better half of the last decade, prices have been growing on average at around 2%. It's not until, of course, 2021, 2022, on the back of very, very aggressive quantitative easing, that inflation pretty much took off, not just in the US, but globally as well. And now all central banks all over the world are starting to pull back on their interest rate hiking cycle. They're pausing, they're cutting. And as a result, of course, inflation's already on its way lower. So what we want to make sure, of course, is that it doesn't start to reaccelerate, because that is going to be probably the worst situation to be in, because higher interest rates with the lagging effects can put an impact on the economy eventually. Sooner or later, it's going to happen. Of course, the economy continues to be very resilient. We've seen very strong jobs growth, and the labor market's very tight. But sooner or later, eventually, if rates stay high enough for long enough, then that's going to affect the economy eventually. And of course, at that time, we want to make sure that inflation's already back down to the Fed's target, because if it's not, then the Federal Reserve is going to be in a big dilemma whether to raise rates, cut rates, or keep them where they are, because it's in their dual mandate, right? Dual mandate pretty much says that they have to focus on both inflation and unemployment, right? So they can't just focus on one thing, because both of those things require different types of monetary policy. One of them requires quantitative easing, the other one requires quantitative tightening. So it's kind of going against both of those dual mandate that they already have. So hopefully that kind of answers a little bit of your question. But Milan says, my wife said if she didn't meet you, she would cut me off your caddy streams. So Milan, like I said, man, spend time with your family. I think that's more important. Of course, if you have time available and if you want to be a little bit more active, then of course I'm always going to be here. My live streams, my videos, content, Discord, everything's going to be here. But the most important thing is, of course, you spend time with your family. I think that's the most important thing at the end of the day, because market's not going anywhere. Market's going to stay here today, tomorrow, years from now. You come back, the markets are still going to be here. It's going to be the same emotional psychology, markets moving in the same way. But of course, time missed out with your loved ones is not coming back. So I think that's the most important thing. Okay, so how technical is looking like for TGLS? So Kevin, I'll take a look at that in just a minute. I want to quickly go through some other comments here. So good morning, everyone. Thank you so much for joining. Can you confirm that IBIT BTC ETF is already plus 25% in pre-market? Is that possible? I'll take a look. So a lot of them are going to have that inception price, right? Inception meaning that what price are they going to be listed at? Just like an IPO price, ETFs also have an inception price. And then eventually, of course, the market price is going to fluctuate depending on where it ends up trading at, depending on the demand and supply. But a lot of these are going to have that inception price. This is nothing but just what is the price that they're going to be listed at based on the amount of shares that they are issuing out in the open market. So that is something to keep in mind. It could be up plus 25, 26% because there's still going to be that pre-market trades happening for all these ETFs, all the 11 ETFs. Okay, so any thoughts on Enphase? So I actually did a video on Enphase as well. We've talked about Enphase quite a lot on our other videos, so definitely do check that out if you haven't already. I think that's going to be more helpful. It's going to help you better understand what my analysis is. Low 100s is going to be that support for Enphase at the moment. Okay, currently I'm having 11 companies in my portfolio. Is there any standards for a good portfolio in terms of number of companies in itself? If I add more companies to my portfolio, is it going to be a problem? So that's a very interesting question. I'll come back to that. Before that, let me just quickly go over TGLS for Kevin. Let's take a quick look on the daily chart. So TGLS over here, Technoglass, and right now this is the overall analysis. We actually did a analysis on this stock, right? So we talked about how this is a very strong sort of company in terms of very stable business. And of course, we're seeing the revenue increase. We're seeing the profitability increase. Margins are doing really well. And from its lows of about $28, $29, it's rallied over 56% really, really well. So the next target and resistance is going to stay put around here at $46, $47. In line with this, again, previous support acting as a resistance right now. And if we extend this range out further, that is going to be that support level to also watch for Technoglass, right? So that's a very strong support, resistance all the way up to 46.90. RSI showing some signs of some potential weakness, and so is the MACD. So if it ends up, let's say, coming down to $37, $38, $39, that's going to be a very strong and good support for Technoglass. Okay, so Srinivas, having 11 companies in the portfolio is not bad. It really depends on person to person, right? So it depends on how active or how passive you really want to be, right? So if, you could have the total stock market index fund, or you could have the entire Vanguard S&P 500 ETF, and that will allow you to invest or have exposure to over 500 companies in the US, largest 500 companies in the US, or the total stock market index fund is going to have you have exposure to all the companies, all publicly traded stocks in the world. So it really depends on how do you want to invest. So if you want to just track the S&P and track the NASDAQ, track the market, which of course is going to lead to some average returns because that's the averages. There's nothing wrong with that. And you can be a little bit more passive, consistently invest in those ETFs or index funds regularly, whether it's every month, every week, depending on your frequency. So that's, in my opinion, kind of like the bedrock, right? That's kind of like the foundation of your portfolio. I do that too. Like I have VUG, I have SMH, I have a lot of ETFs that I've consistently invested in over the years, and I continue to do that because that's kind of like the foundation, right? That's something that you can always fall back to if things don't go well according to your plan when it comes to individual stocks, investing, or trading in general. Then on top of that, you can start being a little bit more active. And the number of stocks is really going to come down to what's your conviction level, and everything's an opportunity cost, right? So if you believe that 11 stocks is enough, Warren Buffett has had 20 stocks. Bill Ackman has had 10 stocks. ARK ETF, Kathy Wood has had 30 stocks. So there's no right or wrong answer. It just depends on what works best for you. If you can manage, track, and actively kind of keep up with 11 companies or 20 companies, then that's totally fine, right? That's totally doable. But of course, anything over 25 and 30 becomes unmanageable, right? If you're actively investing in any individual stocks. We can't even sort of fully understand or grasp the businesses of over 30 companies. It's very difficult, right? So I'd much rather focus on quality over quantity. So again, anything that's under 20 and over 10, so like 10 to 20, that's kind of like the sweet spot if you're actively investing in individual stocks, because it's easier for you to grasp their business, understand what they're doing, understand their market, understand their weaknesses, strengths, and of course the fundamentals of those businesses, and kind of keep up with the earnings. Because really, if you're looking at 20 stocks, 4 quarterly earnings a year, that's 20 times 4, that's 80 earnings calls that you'll have to listen to in a year, right? That's 80 days in a year that you'll have to spend actively at least listening to their earnings call and spending time kind of researching their balance sheets and cash flows and all that stuff. So it's a lot of time, right? It takes a lot of time. So that's why it's not easy. Okay. Let's see. Good morning, everyone. When are the numbers dropping, MP? They come out at 8:30 a.m. Eastern. So in about 23 minutes, a couple more minutes, I'm going to take some of these questions, and then we're going to jump over to our presentation for CPI, for inflation. We're going to go over some expectations and, of course, the market's potential reaction for inflation numbers as well. Also, do drop a like on this live stream, everyone. I would really appreciate that. So 51 likes right now. We can easily get up to over 200. So we got over 300 people watching. And also do participate in the poll. And what you think inflation numbers are going to be for core CPI more specifically. So core CPI, very, very important, because that's really what the Fed's preferred measure of inflation is. So Hertz is dumping their Teslas. Tesla stock is dropping. So let's take a quick look. Tesla, I've got covered calls on Tesla again, so maybe they will do well. But right now it's flat. It's not really dropping at all right now. So Tesla, Enphase, and Apple are dogs right now. Basically flat. Apple, we took a trade at around 180. So 183 was kind of like that entry price. So we'll continue to monitor where Apple trades, kind of at that 200 simple moving average as well. Okay, so the Fed is pretty good at manipulating the market and let it crash. I want to go shopping. Trucking Forever says, yeah, of course, everybody wants to go shopping, and that's exactly why it's important to have some dry powder, some cash available on the sidelines, because at the end of the day, it is incredibly, incredibly important to never be all in, because if you're always all in, you have no cash sitting on the sidelines to invest, right? That's why kind of my cash fluctuates between 4 and 30%, right? So I will never be all in, and I would also never basically be not invested in the markets, because timing the market is very difficult. Time in the market, of course, always is critical, because if you're investing with a time horizon of over 15 years, 10 to 15 years or longer, the probability that you lose money is less than 1%. So you always, in my opinion, want to be invested in the market. But of course, you can play around with that cash exposure depending on how well you are understanding valuations, market technicals, breadth, all that different stuff that we have talked about. Okay, so Superman Kryptonite, I thought you said market will go down first half of the year. Now you look excited, bullish. Does your sentiment change every morning, evenings? SMH shaking my head. So, okay, very quickly, I want to help you better understand that over here on the channel, especially here on MoneyVest, we don't make predictions, okay? So we're not here to make a prediction on where the market is going to go, because nobody is going to be able to make that prediction. Nobody. Doesn't matter who it is that you're watching or listening to. Nobody in the world can tell you exactly what a stock or a market is going to do a week, a month, let alone a year from now. Nobody has any idea. That's a very hard, cold truth about the market. Anybody who makes a prediction is going to be wrong eventually. Okay, so what our analysis, or what really is important for us, is understanding and assessing the current situation. Are the markets right now, today, overvalued, undervalued, or fairly valued? Are individual stocks we're looking at, whether it's Apple, Tesla, whatever Magnificent 7 stocks or core stocks, are they actually trading at reasonable valuations, expensive valuations, or cheap valuations? What do the market technicals tell us today? That's it. So we can make a decision today and not make a prediction, and this may or may not happen, right? So right now, I can tell you from what the markets are. Of course, we're a bit more overbought. We're continuing to push higher. We're hitting, almost new all-time highs. A lot of individual stocks valuations are, at an expensive level. So am I aggressively buying right now? No. Volatility is low. Market breadth is really high. Concentration is really high. So right now, it's a very simple playbook. All I'm doing is sitting back, enjoying these gains, and also selling calls at the same time. If you look at our Discord, if you look at our community, ask anybody, I'm not really aggressively buying right now. That's it. I'm not aggressively buying stocks at the moment. I'm simply selling calls or sitting back and enjoying the profits, and of course, de-risking a little bit. So if there's any stocks that I think are somewhat overvalued, or we're getting tomorrow's price today, simply de-risking a little bit. Tesla, yeah, so I will definitely respond to comments. There's not really a lot of comments, but yes, I will respond to them as soon as I get those. Okay. If you're going to have over 20 stocks, just buy an index fund. Plus, it's easier to sell covered calls and hedge through options as well. Yeah, so that's also a good strategy. But again, with the indexes, you're getting, of course, over 500 companies. There might be a lot of stocks that you may not necessarily want to own, but it really comes down to, again, person to person and what their strategy really is. Okay, so we're going to switch gears now to inflation. And let's see. Tesla John says, I wouldn't buy Bitcoin ETF today. If you're better holding long term, it will drop. AMD can get better prices just like IPOs. Christopher says, do these YouTubers care more about eyes watching their vids? Last week was an obvious bear trap. And if you think 2024 is going to be bearish before QE, you're fooling yourself. Of course, YouTube is all about views. It's all about content. Welcome to the real world. That's what business is all about. But at the end of the day, like I said, we're not here to make predictions. We're only here to assess the current market situation and whether we're overbought, oversold, technically and valuation wise, what is making sense for us to do today. Not based on any predictions, what is making sense for us to do today. That's it. All right, so switching gears to inflation now, we're going to go over some of the numbers. So if you come over to the expectations, so for the December forecast, Bank of America coming in with headline at 3.3, core at 3.9, so which is going to be a little bit hotter than what the market's expectations are. By the way, let me quickly go over what the expectations are from the market. So again, headline inflation 3.2 and core at 3.8. So core inflation strips out any food and energy items because they're really, really volatile. So excluding food and energy, we're looking at 3.8%. Headline, we're looking at 3.2. Month over month, 0.2%, and core also month over month, 0.2%. That is the consensus going into today in less than 15 minutes. Barclays in line with the market forecast. Citigroup is only giving us headline 3.9. Deutsche 3.9 and 3.3. Again, hotter than expected. Goldman Sachs also 3.3 and 3.9. Morgan Stanley 3.3, 3.9, as well as Nomura. TD Securities 3.2 and 3.7. That's probably the only bullish assumption that we have from one of these banks, and UBS at 3.3 and 4% for core as well. So median forecast is 3.3, which is going to be higher than what the consensus is, and 3.9% for core, which again is going to be above what the consensus is. This is Goldman Sachs playbook. So they're expecting if core inflation comes in at 0.27% or lower when it comes to the month-over-month gain, only then they see the S&P 500 rallying at least 40 basis points to as much as 150 basis points. If it comes in at 0.3% or higher, then they see the S&P dropping anywhere between 20 basis points to as much as 2% today. So based on inflation numbers. Mohammed El Arain says, welcome to US CPI inflation day, where consensus forecasts expect the core measure of December to edge slightly lower and the headline measure slightly higher. Specifically, an expected 0.3% monthly increase in core would lower this annual rate to 3.9%, and a similar increase in headline would increase this annual rate to 3.3. So that is, again, the median forecast. And importantly, absent improvements on the supply side, the outlook for continued disinflation to 2% is likely to get trickier from here, the so-called last mile challenge, and something that we have discussed on our channel before as well, which is it's much easier to get to 9 to 4%. It's a lot easier for inflation to come down from 9 to 4%. It's a lot more harder. It's a lot more difficult for inflation to go from 4 to 2%. Kind of think of it when you start losing weight, right? Or basically you want to get down to a really, really low body fat percentage, as I've given this analogy in the past, where we talked about it's much easier to go from, let's say, 20 to a 12% body fat, but getting from 12 to 10% is really difficult, right? Because then that requires a whole different level of diet, whole different level of workout, whole different level of just lifestyle in general. So that's why for inflation as well, it's a lot easier to go from 9 to 3 or 9 to 4. It's a lot more difficult to go from 3 to 2 or 4 to 2. So that's what the last mile challenge basically is, which is, inflation is going to get more and more challenging to bring down, especially when the Federal Reserve now is considering lowering interest rates, as the market's expecting 6 to 7 rate cuts this year. So this right here is going to be the equity put call ratio. Earnings Whisperer basically mentioned that the only time this was ever higher was December of 2022. So that basically means there's more put options open in the market than there are call options. So that's why this ratio is above 1. 1.55 is where we are. And the total put call ratio is 1.28 at the moment. So definitely these are hedges, right? This is not necessarily a bearish indicator. This could simply be, institutional investors, traders in general are hedging potential downside on the back of inflation numbers because the forecast is a little bit hotter than expected. So we'll find out again in just a few minutes, in about 15 minutes, what those inflation numbers end up looking like. And finally, this right here is the S&P 500 election year, going back as far as 1950. So going back over 70 years, we are looking at very, very consolidated pattern. In other words, the market basically trades flat in the first 3 months, and then it starts to rip during election years from basically second quarter all the way through the end of the year. But of course, just because it's happened in the past doesn't mean it's going to happen again. But this is just a seasonality sort of indicator that during election years, going back 70 years, markets have done really well. They've consolidated in the first quarter, but they've done really well towards the end of the year. So coming back over to some of the comments here. Okay, let's take a look. Volatility is best for environment for options. Fully agree. The poll is tight. Yes, it is very, very tight. Definitely do participate. So 310 votes. Let's see if we can at least get up to over 200 likes. So I would really appreciate it if you drop a like, participate in the poll, and of course, share this live stream with anyone who might be interested in joining us. This right here is the Federal Reserve's dual mandate. And we already know the market's pricing in 6 rate cuts right now. So 1, 2, 3, 4, 5, 6 rate cuts is what's being priced into the market at the moment. And the Federal Reserve's only told us 3. So hope you all are ready for inflation. CPI, it's always a fun day. QQQs right now, pre-market up about 0.5%. We got the SPY up 24 basis points. The 10-year treasuries are dropping back lower, down about 1% to under 4% at the moment. And of course, a lot of big tech core Magnificent 7 stocks are pushing higher. Nvidia's been on an absolute rally here, up another 1.5% to $550. Advanced Micro Devices also up 61 basis points. Apple here, on the other hand, up over 41 basis points to 187 almost. Again, perfect trade opportunity. 200 simple moving average was sitting perfectly there with an oversold RSI and MACD. And again, this is exactly the whole idea. We're not predicting. We're simply reacting. When Apple comes down to that 200 SMA, it's oversold. It's at a very strong support, right? So we create a plan that, okay, this right here, the risk reward is really good, right? It's very, very optimal. Risk is low, potential reward is decent. So we take a trade here. If it works out, great. If it doesn't, we get out with a small loss, right? That's why the stop loss is right below the 200 SMA. If it breaks below 180, we're out. And then what do? We reset and recycle this trade back down to 165. So the moment it gets down to 165, that's when we start to recycle this trade and take a trade once again for that potential upside with, once again, a stop loss below 165. So it breaks below that level, we're out. So we're always in the hunt for those asymmetric opportunities where the risk is low, the potential reward is high, with no predictions, but simply looking at and assessing the current situation. So Apple is a prime example for why we're doing that. Okay, so hope AMD holding this level. I see big moves up or down depending on CPI, Bobby says, of course. I mean, there's going to be volatility. The question is, of course, which direction the market's going to move. And that's the interesting thing about inflation and any other macroeconomic indicator, right? Markets are so interesting that you could know the CPI numbers today, or you could know what the Federal Reserve is going to do the next meeting. You could know what the speech is all going to be about and still not fully be able to predict what the markets are going to do, right? Think about that for a second. We could know exactly what a company may report earnings-wise and still not know how the stock might react, right? That's the crazy part about the markets, is that sometimes good news can be priced in a negative way and bad news can be priced in a great way, and the markets can rally, markets can go down. That's the beauty of how unpredictable things are. And yet, of course, people always try to predict the market, which is, in my opinion, some of the most useless things and a waste of time. As Peter Lynch has also mentioned, right? If you try to predict the markets and you spend 15 minutes trying to predict the markets, you've wasted 13 minutes or 14 minutes. So it's not really worth it. Apple annoys me. I was going to buy it, but I waited for 160, and here we are. Maybe a swing trade to 199, 200. Yeah, so I mean, a breakout over 190 can potentially put us back on the map to getting up to 198. So 198, $200, that's going to be that next resistance and target level to watch for Apple. So, you know, I would say the risk reward is still okay if your trade setup is up to 190. So if you take a look at this buy price, stop loss is still below that 200 SMA, right? Of course, if your target is 190, this is a really, really bad looking trade, right? I wouldn't take this. I would take it at around 181, 182, because now look, there's more green and less red. The risk reward is really good. But if you have an entry now, your risk potential is much bigger than your potential for reward. Of course, if you've got a profit target up to 198, then look what happens. Your profit target is slightly better than the potential for reward, right? So that's almost a 1.5 reward to risk trade. Is it ideal? I mean, I look for 2 to 1. 1.5 to 1 is also decent, but of course, the better entry was around 180s, 181, 180 around those levels. Even I entered late because I was occupied with some other stuff, so I actually entered at around 183. So, but that's the idea, right? You don't have to chase trades that have already run, that have already moved. If this happens, move on to the next trade, move on to the next opportunity, because if you chase something that's already moved, you are drastically shifting the overall risk reward paradigm. The entire dynamics changed. Like, you're risking more to make a little bit less, and that's not the ideal trade setup. So that's why something's moved, we look for other trade opportunity. Okay, so inflation in now under 8 minutes, folks. Everybody, hope you all are ready. 356 votes right now. Let's see if we can at least get up to 500 votes before the CPI numbers come out. We've got 500 people watching. Somebody has definitely not voted. So vote and what you think about inflation numbers in 8 minutes that come out. We're going to do an audio check here fairly soon to better understand. Kathy Wood is talking right now. So if anybody wants to listen, let me know and I'll turn this on. But I'm sure she's talking about the new, she's talking about the Hertz cutting back on EVs. So maybe Tesla stock can be affected by that. But of course, Bitcoin, it's a big day for Bitcoin as well. So that is all going to be on the radar. So ARKB is going to be the ARK shares on Bitcoin. And we'll see where all of these ETFs end up opening and how they perform on the day. Okay. All right, banks really off high CPI thing. So banks are reporting earnings later this week. So Friday is when the bank earnings begin. Still day trading some of that move. All you said, Caddy, is 100% right. Thanks for talking me out of this Apple swing trade. Appreciate you and your thought on AMD, please. So AMD, Stefan, I did a video on AMD yesterday, so definitely do check that out. There's a whole detailed analysis on AMD. So yeah, but as you were saying, when it got to 185, I'm not interested in that right now. Yep. So, unless your target's up to 190, Apple trade is going to be off the table, at least at the moment. Okay. So, folks, we've got 6 minutes. 6 minutes to CPI. 6 minutes to CPI. Vote, participate. We've got a 37% consensus right now that core inflation is going to be under 3.8%. So we're going to see a better than expected print on CPI. 30%. It's actually pretty tight. We've never seen a poll this tight with a split majority, like split in all three consensus forecasts here, all three options basically. So 30, 33, and 37, slight edge to softer than expected inflation numbers coming out today. So we're going to get ready. On this chart, all we're going to have is we're going to have the NASDAQ over here, so QQQs. We're going to have the S&P 500, so SPY, the 10-year treasury, so the US 10-year yield. We're going to put the dollar index just for the sake of seeing how it responds to the inflation numbers. So dollar index is just a little bit over 102. So we'll see how this ends up reacting to inflation. So that is going to be the 4 charts that we're going to focus on. And of course, we'll take a look at volatility after. Right now, it's up over 71 basis points, so just a little bit under 13 right now. And then, of course, dissect the entire report when the numbers come out. Let's do this. Let us do this. It is time. This is what we wait for each month, CPI, because that's really what dictates, interest rate expectations, market reaction, market direction for the week, for the month. So let's do this. And I'm going to do an audio check. So hopefully everything is working. And 5 minutes. So we got a couple more minutes to talk. And we'll see. We'll see what CPI has in store for us. So Edward, any more trade ideas? I'm late for Apple. Yes. So we'll be sharing some option trade ideas as well for everyone. So that is something to keep in mind. I'll do that in our Discord, and I'll also go over some other potential short trade ideas as well, considering how much the markets have moved up. So we'll talk about that in our Discord as well. Under trade ideas, I'll share some other tickers to be watching, tickers that I'm potentially going to be trading and looking to sell options on those as well. Pandemonium, welcome. It's been a long time, man. How have you been? Let's see. So depending on how much you zoom in and out, how much of a natural gas is an uptrend or in a downtrend at the moment. So we can very quickly take a look. So UNG, so United States Natural Gas Fund, I mean, it's clearly in a downtrend. So of course, from highs of $34, it's down 81%. But then of course, it consolidated sideways a lot at around these levels. So this right here was a lot of consolidation. This right here was a lot of resistance for natural gas fund here. And then of course, it broke down and now it's starting to recover back up. So this would still be a support level to watch for natural gas, but of course it's incredibly overbought right now. So, I'd be careful. Of course, there's not a trading opportunity in my opinion at these levels, unless of course the RSI MACD kind of stabilizes a little bit. Price also stabilizes around $6. So we'll keep a close eye on that. Okay. So is MARA good for entry now? We'll come back to that after the CPI numbers. So IK, doesn't matter what CPI is, market is going to do what it interprets. Well, duh. We know market's going to do whatever it wants to do based on the CPI numbers. So CPI numbers, of course, do matter because market's reaction is dependent on the CPI numbers. So Edward, yes, you can subscribe to the Patreon from the UK. Would like to learn options like you have mentioned in your previous post. We've got a whole specific playlist on options. So you can go over and go to the videos tab and you have access to all the members only videos where you can access all the tutorials and lectures on options trading, including selling options. That's the primary goal, is to be able to help you generate cash flow and income by selling options. So that's what we're going to be focusing on. And yes, you can access all the private videos that are available on Patreon. So links going to be down below. I think a couple more spots are open if you want to join. So I'm going to shut up now. I'm going to include the voice from MacBook and we are going to be ready. All right, 1 minute. 1 minute, folks. 1 minute. Give me a thumbs up on the audio, right? As soon as it starts working. Just give me a thumbs up on the audio. All right, 10 seconds. Let's do this. Let's see what the numbers are like.
We are just seconds away from the December CPI. It's a number the markets have been anxiously awaiting, getting a check on consumer inflation right now. Dow futures up by about 33, S&P futures up by 10, the NASDAQ up by 88. Rick Santelli is standing by.
Our consumer price index read for the month of December by the Bureau of Labor Statistics, expected to be up 0.2%, is up 0.3%. And if you strip out food and energy, it is exactly as expected, which is up 0.3%. Just like in the rearview mirror, that headline number is 0.2 higher than the rearview mirror, which was up 0.1, and the prior month, October, was at 0. That was the lowest since May of 2020. Let's go long here. Year over year CPI expected to be up 3.2 is up 3.4, up 3.4. The best it's been was 3.0 in June of last year. That was the best since March of 2021. And finally, there is progress. My favorite, the CPI core, year over year, which has not been below 4% since May of 2021. I could now take that out of my repertoire of what I say on CPI day, because 3.9%, 3.9%, which is the best since 3.8 in May of 2021. Now, here's something I normally don't discuss. If we look at the index itself, the non-seasonally adjusted actual index, it came out at 306.746. Why is that interesting to me? Because the all-time forever high was in September at 307.8, very close. But here's something, if you take core CPI, the actual index, which is seasonally adjusted, the read there is 313.216. That probably doesn't mean anything to you. It means something to me. That's the highest it's ever been. It's ever been. Now remember, Bureau of Labor Statistics brings out this number. Go to their website. When did COVID start? March of 2020? Okay, this is a decent number. That means NOV was the most updated we had prior to about 2 minutes ago. If you go to their website and you look at their CPI inflation calculator and you put in Feb of 2020, what you'll find is it takes $1.19 of NOV $23 to buy what bought $1 pre-COVID. Do it if you don't believe me. Now, let's do initial and continuing claims. Initial claims, 202,000. That's the best since the second week in October of last year. And finally, on continuing claims, 1,834,000. 1,834,000 is the lowest level since the last week in October. And we see interest rates shooting up. It's all on the CPI data being hotter than expected. You know those annualizations? Well, 0.3 changes that math just a bit. Becky and the panel, back to you.
Okay, here we go. Rick, stay with us. Joining us right now for more on that new inflation data, Wendy Edelberg, Senior Fellow in Economic Studies at the Brookings Institution, Joel Griffith, who is Research Fellow at the Heritage Foundation, and of course our very own Steve Leisman. Steve, let's start with you. Why don't you pick apart these numbers?
Well, just a topical comment first, Becky, which is that I think this is something the Fed has tried to prepare the markets for, the idea that, yes, there is improvement in inflation, and as John Williams, the New York Fed president, said yesterday, it has been significant. There's still no doubt about that, even despite these numbers. But the trajectory for getting from here to there is not a straight line. The data can be both noisy and it can bounce around quite a bit. There are some interesting numbers here that not all of which don't make a lot of sense to me. But one thing that we see here is that in December, there's some reversal of some of the declines we had in prior months. The first thing I will say is we did not get any help on the owner's equivalent rent part. That was up 0.5%, continuing the same level as last month, and kind of defying what we're seeing out in some of the market-based metrics of what's happening in rents. Bottom line, the CPI has not picked up the decline in housing. We saw new vehicles up 0.3%, used up 0.5%, airline fares up 1%, and actually the energy sector added to inflation as well. I'll leave it there, except to tell you that these are all categories essentially that have been on the decline, and at least for the month of December, they reversed themselves. This is the sort of thing, I think, and the sort of report which gives the Fed patience, and is part of the reason why the Fed has said, you know, don't get ahead of yourselves, market. There's still a lot of stuff that has to work out here.
Wendy, let me ask you, when do you anticipate that the Fed is likely to cut rates?
I think it's going to have to be when the Fed looks at expected outcomes and says, if we don't cut rates, we are going to undershoot our inflation target and persistently undershoot, like not just a 1 month thing. So it has to be that they get to a point where they think monetary policy is so tight that if they don't cut, they will overshoot on their inflation target. And I don't think we're anywhere near that. Like, I think what these numbers say today is that the Fed's doing the right thing and they just need to stand pat.
How about you, Joel?
Well, let's be honest here. The Federal Reserve has been overshooting its inflation target for close to 3 years now. And we still see, even with the Federal Reserve nearly declaring victory, inflation still at 1.5 times their target. And this has translated into a $4,000 real income decline by families. I think it's very interesting to look at credit card balances. Those balances have increased by almost $4,000 per family over the past 3 years. And compounded with the interest rates, we see credit card default rates at the highest since 2012 and added interest costs of close to $1,600 per year. We are in a big mess here, and middle-class families are feeling it the worst.
Hey, Steve, earlier today we had Mohamed El-Arian on, and he was talking about these 3 huge headwinds that you have in reaching the last mile, or whatever you want to call it, of these higher inflations. One is issues like the Red Sea, where you're seeing input costs that are going to be going up because of problems along the supply chain. Second is the change in the base. It's going to be tougher, the headline comparisons from here on out, because you're talking about lower numbers relative to what you had been talking about the 12 months before that. And the third would be this idea that we've seen goods deflation. If you want to continue to see inflation come down, you're going to have to see services inflation come down, and he's not sure how likely that is. How about you?
I'm a little more optimistic on that third element there, and actually on the other two. I kind of believe in, I guess, capitalism and the ability of the market to provide supply. I think there's this thing going on that I'm working on, which is supply-ophobia, Becky, is that everybody's afraid because we had all these supply chain issues from the pandemic, that if you have growth, that the supply chain won't be able to meet that growth and will cause inflation. It's not the way the economy used to work, and I think there's still some going back. There is a constraint when it comes to labor, but somehow we have found the workers to power the growth that we've had this year. So I'm a little more optimistic of the ability of industry, of the ability of business to meet supply if there is more growth. On the service side, I do still think we have in our future this decline in housing costs, because I'm looking at this data out there from Zillow and others that shows rents declining. And I also think that you have had some attenuation in wage gains, and that should enable those on the service side to eventually begin to reduce. So I think there's a path. I think we're on that path. That path is downward. It perhaps is slower from now because of what Mohamed talked about. Some of the better numbers or the higher numbers dropping out. The base effects aren't as strong. But I just think it's bumpy, and I have feared from the very beginning, from the moment that the market started pricing in on that Wednesday 6 rate cuts, that the market had gone too far, that the data does not behave the way the market wants it to behave.
Hey, Rick, the people looking at the economy angle of this are kind of in agreement that they don't think cuts are coming as soon. What do you think, just as someone who's watching the markets and trying to figure out the market's anticipation?
You know, the Federal Reserve had an interpretation of the data. Markets only can divine inputs, and the input that it divined was the interpretation of the Federal Reserve and most Fed speak and most of the implied language over the last several meetings that basically hinted at the notion that the tightening cycle is pretty much done. It was accomplished. Annualized well within the area to come into our target.
All right, everyone. So coming in hotter than expectations here, and kind of like the overarching view is that the market is very ahead of itself when it comes to rate cuts. And, we've talked about the potential disappointment from markets' expectations being really high versus the Federal Reserve potentially under-delivering on the rate cuts. And that's, I think, one of the reasons why the markets are selling off, not to mention that we came in a little bit hotter than what the expectations were, because CPI headline came in at 0.3% month over month, hotter than expectations. Year over year came in at 3.4%. Not only is it hotter than expectations by 20 basis points, it is also accelerating back up. It is also accelerating by 30 basis points. Core coming in at 0.3% month over month. Once again, hotter than expectations. And ex-food and energy, which is core inflation year over year. Yes, progress from the previous month, coming from 4 to 3.9, but hotter than what the expectations were. So all four accounts, numbers came in worse than what the consensus was. So in the poll, 37% people that voted for coming in above expectations for core were indeed correct. 29%, so a third of you voted for core inflation coming in a little bit hotter than what the consensus was. And, the market's obviously pricing in from the last account, 6 rate cuts. We'll take a look at this very quickly. It still takes a little bit of time to readjust the Fed funds futures. So we'll come back to this. But the idea is that if you take a look at this chart, which is very clear, all items inflation, right? So take a look at where we are at 3.4, which is accelerating back up from 3.1, 3.2, back up to 3.4. And we haven't moved since June of last year. So it's been, 6 months? 6 months, inflation, headline inflation has been at 3%, 3.4. It's been pretty stable over the last 6 months. And then if you take a look at core inflation, the last mile, which is basically talking about we are going down, the rate of increase is going down, but it's not going down fast enough. And that is something that we talked about with the analogy of it's much easier to go from 9 to 4, but it's far more difficult to go from 4 to 3, right? Similar to what we talked about with our analogy, but when you're trying to lose weight or we try to get down to really, really low percentage body fat, it's easier to go from 20 to 12, but much more difficult to go from 12 to 10. It's the same thing true with inflation, that we're now starting to stabilize a little bit. Now, some of the things that increased, once again, shelter prices. So if you come back to the report, shelter prices over here, up a little bit over 0.5% month over month. Year over year, that's over 6.2%. That is, again, a very significant increase year over year, and month over month also, 0.5% annualized. That's just over 6%. Used cars did decline in the previous months, but they are now over the last couple months in November and December, they're up. So 1.6% in November and 0.5% in December. And year over year, their deflation is going away. So it was at one point down over 3 to 4% deflation. Prices were going down for used cars, and now they are accelerating back up. Same thing is true with oil. So oil, you'll notice oil was a big sort of contributor to inflation coming down. So fuel oil more specifically, minus 5.5%. So as we identified that in the previous video where we talked about the crude oil prices, that they were down in the month of December. And year over year, it is in straight up deflation. So the only things that are really contributing to overall inflation coming down is energy. Energy is still down on a year over year basis. Everything else, except for used cars that were down more, that are now accelerating back up. I mean, look at transportation services, 9.7% year over year, 0.1% month over month. Medical care services are also in a little bit of deflation, but it's really energy that's playing a big role when it comes to inflation trending lower. Food still up, still increasing month over month. And we have still seen food items, if you come back to the chart. So food at home, almost coming down to deflation. So that is a pretty good sizable decline. Energy is still, in deflation. So prices are coming down, but the real sort of letdown is always going to be shelter, because yes, it's coming down. Yes, rents are not going up at the same rate. The rate of increase in rents is declining. But we are nowhere near close to 3 to 2% or even deflation. I mean, if this was in deflation, that would have helped so much, but we're nowhere near close to 0%, let alone below 0%. So that's where we are. QQQ is obviously declining a little bit on that news, but still pretty flat on the day. S&P 500 is also very flat. The 10-year treasury is back over 4%, and the dollar index is basically flat as well. So not a lot of momentum from the markets. Of course, the pre-market gains are the only things that is lost right now. And volatility here continues to slide lower, down about 0.5% as well. So trading at just under 13 at the moment. Individual stock-wise, so if you go over, let's take a quick look. Marathon is up over 4.4%, of course, on the back of crypto and the ETF. But let's take a quick look on Apple here. Flat, so basically sold off and gave up some of those gains from pre-market. Amazon, on the other hand, was also down, I believe. So let's take a quick look. Amazon here slightly up, still pushing up 73 basis points. And Tesla, on the other hand, is also selling off down about 0.5%, but it's also got its own reasons when it comes to Hertz. And Nvidia, which was hitting a new all-time high, pre-market at over 551. Pre-market at the moment, it is going to be up still 1%, just a little bit under $550. So Frank, ELF has been on fire. Did you enter that trade? Not yet, but I know that I think I did a video on ELF Beauty. It's just been a phenomenal company. It's been an incredible stock. It's performed really well. And of course, from lows of October 2023, it's up over 75%. So congratulations if you were able to take that trade here. Something I don't understand, wouldn't high interest rates keep shelter prices high due to high mortgage financing costs? Not quite. I mean, if there's high interest rates, the demand starts to taper off, right? Because if there's higher interest rates on mortgages, if you're looking at 7-8% mortgages, well, there's not going to be enough buyers, right? Not a lot of people can finance homes at over 7-8%. So if the demand starts to go away, and if there's excess supply, prices eventually start to come back down. That is a softening in the real estate market, which we quite honestly haven't seen yet, because sellers are too stubborn to lower prices because they're financed at sub 3%, sub 4%, because they're refinanced aggressively back in 2020 into 2021 after interest rates were cut down. And the buyers, of course, are still somewhat in decent shape because we've seen the jobs market, the labor market super strong. The single most important indicator. Let me see who's been doing their homework. So what is the single most important indicator to identify the potential health for an economy? Let me see. One thing that really, really dictates how well the economy is going to do eventually? What is the one thing that we really pay attention to? Which also came out today. So let me see if anybody can answer that question. So interest rates will go up today. So they are pushing higher right now. So the 10-year treasuries are a little bit up on the day so far. So we'll continue to see how it ends up trading. So let's see, Caddy, I'm thinking of selling to open covered call on Amazon. What are your thoughts? Any particular strike date and expiration you would recommend? So I would go for 30 to at least 45 days out in expiration. And strike always needs to be above your cost basis. So that is kind of rule number one. If you're selling covered calls, always look for strikes that are above your cost basis because you don't want to get called away on your shares at a price below your cost basis because that is a guaranteed loss. 170, I don't know what 170 strikes are like in terms of premiums, but I think 170 could be the next target and that next resistance to look for. So I would be looking at 30 to 45 days out, 170 strike depending on the premiums, and it also depends on whether you're willing to let go of the shares or not, because that is very important. Because if you're comfortable letting go of your shares at 170, then that's a good strike. But if you want to hold on to the shares and still want to have some premium come in, then you can go even further out of the money at close to 188 or 190. The premium is going to be really low, but hey, at the end of the day, it is almost free money, right? Because the probability of Amazon rallying over 22, 23% in the next 30 days is quite low. Not saying it's not possible. It is possible. Anything is possible, but it's quite low. Probability-wise, it is going to be low. So that is something to keep in mind. Yes, employment. You guys are absolutely right. Jobless claims, employment, that is the most important marker for understanding how well the economy is going to do. Johnny says Donald Trump. So right now, employment's super strong. We've got a very, very strong labor market. We've got a very strong jobs market. So keeping that in mind, buyers are still pretty well capitalized when it comes to cash that keeps coming in, and they can finance a lot of debt. They can finance a lot of spending at the moment as well. So SoFi, I will be doing, your voice is echoing. Is my voice echoing right now? Is my voice echoing or is it okay? Let me know in the comments. Just want to make sure there's no technical difficulties and we are good to go. But anyway, so SoFi I will be doing an earnings video very soon. So what's your thoughts on the numbers I mentioned earlier? Okay, no, it's okay. Perfect. So mentioned earlier that inflation is stabilizing a little bit, right? So we're not really seeing a lot of momentum lower. In fact, headline CPI has been at these levels in the last 6 months. We're accelerating back up a little bit to 3.4. So, at the end of the day, there is a possibility that we enter into a stagflation type environment. And we may not come down to the Fed's 2% target or lower especially if the Federal Reserve starts cutting rates. Because for them, core inflation is very important. And it's still sitting at 3.9, right? Core CPI to be precise, which is still a pretty aggressive number, almost twice as much as the Fed's target. So once again, thank you so much for joining, everyone. I really, really do appreciate it. And if you have any questions, I'm happy to go over those for all of you. Make sure that you drop a like. We're at 216 likes. Come on, we can at least get up to 400. There's over 600 people watching, so I would really appreciate you dropping a like and subscribing to the channel. And again, like I said, if you have any questions, feel free to message, to ask away in the comments. So Jonas, trade ideas, I will be sharing them in our Discord. So we'll talk about that in our Discord. I will share any other ideas that I may have on individual stocks or options wise. So that entire analysis is going to be shared in the Discord. I will be going over ETFs, like just really 4 or 5 ETFs to make them the core of your portfolio. In my opinion, that's what I'm doing. I'm making those 3 to 4 ETFs kind of like the core of my portfolio that kind of are very selective in terms of the sectors and the themes, tech themes that I think are going to be very important. So we'll go over that. We'll give you guys some very actionable ETFs to take advantage of. And then, of course, go over some other trade ideas for individual stocks and options as well. So that, again, update will be in the Discord later today. Okay. Is NVIDIA a sell? Depends. Depends on a lot of different things, right? There's no clear-cut answer, yes or no. It depends on a lot of different things with respect to whether, what's your time horizon, what's your plan with respect to whether you're trading or investing, what's your current position like. I mean, there's a lot of different variables at play, right? So there's just no way to know or give you a clear answer. Jonas says best Discord out there. So thank you so much, Jonas. Really appreciate it. So our focus main is always going to be on long-term investing. And when I say long-term, we're looking at plus 1 year out, individual stocks and ETFs and indexes. And then of course, there's some active involvement with understanding a lot of fundamental and technical indicators so that we can be more precise and more efficient in the way that we trade. It's always going to be quality over quantity. Less is more. These are some things to always remember. And some of the more important indicators that we look at is market breadth, market concentration, volatility, of course, technicals, market valuations. So we kind of formulate a plan looking at all those different things. So that's always going to be important to us. Okay. SWAV, TMDX have been on fire. Fed used 2% what data, core CPI or PPI. So they use core PCE. So that's personal consumption expenditure. So a little bit different than CPI. Just the way in the way that it's calculated and the weighting of all of that. And of course, Caddy, what are your thoughts on CELH? I think I've done a video on CELH as well, Celsius Holdings. Lots of consolidation sideways in between that level. So $41, $42. That's going to be that support level to watch with a resistance sitting all the way up here where we have gone rejected. So I think Celsius Holdings has been one of the best performing stocks. So from 2011, the stock has gone up over 118,000%. So just an insane amount of gains for Celsius. So fundamentally, I'm kind of surprised that it's done really well. 2022 generated a little bit of a loss. Quarter over quarter, starting to see that profitability come back in. So I'll do a video on Celsius, kind of like an update on this stock very soon. What's your thoughts on that beast NVIDIA? You said it. It's a beast. It's a beast of a stock, right? It's absolutely crushing it. Whatever comes in its way, it's just absolutely crushing how well it's done. So that's really good. But I think the main focus for today also is going to be on cryptos. So Bitcoin here, up 1.3%, 47,200. and of course, a lot of individual stocks here, including Mara, Riot, Clean Spark, not to mention a lot of now spot ETFs are going to be a part of this crypto watch list, and we'll see how well they actually end up doing. So, okay, let's see. So Christopher, what affects the volatility, dollar, and yields, and how do they all affect the market? So that is a very, very loaded question for macroeconomics. But I mean, it's kind of difficult to go over that in just a live stream. I think there's a lot of variables that we need to understand. The yields basically are interest rates, and a lot of the other interest rates are kind of measured by where the treasuries are trading. There's a lot of different things to focus on, because the treasury yields also acts as a proxy to where to what returns risk and reward is going to look like for the market, because the earnings yield on the S&P, which is a reciprocal of the price to earnings, is looked at with respect to where the yields are. So if the S&P is, let's say, trading at a 5% earnings yield, and the treasuries you can get a 6%, that's risk free. So why would somebody take on the risk of investing in equities when they can get a higher rate of return by taking on little to no risk investing in bonds? So that affects the risk reward, that affects liquidity. Then of course, higher the interest rates affects cost of borrowing going up, which retreats the spending among consumers, which lowers inflation, which creates lower earnings. So again, that plays a role. And then the dollar index, of course, affects big tech companies, because majority of their revenues come from overseas. So a strengthening dollar is actually not great news for Magnificent Seven companies. Then you mentioned volatility. Volatility is a fear index, the gauge that helps us track how uncertain the market is with respect to the options that are being trading on the S&P 500. So there's a lot of things, of course. There's, everything's kind of interconnected. And there's, of course, a lot of variables here. Okay. Abhishek says, I see every girl in my gym drinking Celsius. Celsius and Target ain't going anywhere with American women around. God, you need to pick a new gym, man. If people are drinking Celsius for pre-workout, what are they doing? Wall Street is now saying it's Magnificent 5 instead of Magnificent 7, removing Tesla and Apple from the group. Really? Why would they remove Apple and Tesla from the group? That's kind of weird. Thoughts on TLT and TMF after the data is out. So I actually did a video on TMF and TLT yesterday. My analysis is still the same. I do expect the 10-year treasuries to somewhat stabilize. A lot of it is going to depend on inflation. If inflation starts to reaccelerate, right? Where do you think interest rates are going if inflation starts to reaccelerate? Let me ask you this. Very simple question. We got over 500 people watching. I'm sure a lot of you have the answer to this question. But where do you think interest rates are going if inflation starts to reaccelerate back up? If it starts to go back up to 4, 4.5, 5%, where do you think interest rates are headed? Help the kid out and smash the like button. Yes, Andy Irish. Thank you so much for reminding everyone. Please make sure that you drop a like. Let's see if we can at least get up to over 300 likes here on this stream. So join late, but is today expected to be a red day since CPI came in higher? So I mean, markets could easily get bought up on the day, but yes, we are starting to see a little bit of a pullback in overall markets here as inflation numbers came in a little bit hotter than expectations. Going back up, yeah, so higher, right? So if inflation comes in hotter, if it continues to be higher or more elevated, starts to reaccelerate, interest rates are expected to go back up, because that's not going to satisfy the Federal Reserve's target. And what are they going to do? They're going to pull back on their summary of economic projections that's priced in 3 rate cuts. And that's exactly that right there is the disappointment that I'm talking about in most of my videos. Look, I want the markets to rally. Nothing would make me more happy for the markets to rip another 20%, for a lot of these individual stocks to keep going higher, and for us to have a huge party with green candles. I would love that. We'll have a cake with all green candles. We'll love it. But we also have to be understanding of the fact that market is pricing in six rate cuts. What if we don't get 6 rate cuts? What if we get 3? What if we get 4? What if we get 0? Right? A lot of that depends on where inflation ends up being. So that opens the window for disappointment, right? Because markets, high expectations, the Federal Reserve has to deliver on those expectations, because if it doesn't, that's disappointment. I'd much rather have the market's expectations be really low and the Federal Reserve come in with over delivering, and that's when we rip higher. Brian, thank you so much. I would definitely look into that idea. I think that's a good one. And we'll take a look at those Bitcoin ETFs as well. We'll do a video on which ones are worth looking into. Okay. Crash now. Yeah, we're seeing the markets kind of roll over a little bit more aggressively at the moment. Bitcoin's still kind of holding up at the moment on the back of these inflation numbers. We got 30 minutes to market open. So I'm going to spend some time in our Discord kind of answering questions. So I've dedicated at least a couple hours during the day to answer any questions on Discord, and of course sharing ideas and alerts over there. So if you have any questions, please feel free to reach out on Discord, tag me, and I will make sure to kind of go over any stocks or market analysis or anything that you may have questions on. So I'm going to spend some time over there with our members. So thank you so much for joining. Inflation coming in a little bit hotter than what the expectations were. And that again kind of reiterates that idea that, okay, maybe inflation is stabilizing a little bit, still pretty elevated, and there is a potential for some stagflation in the future. And as a result, interest rates are going back up. Markets are seeing a slight pullback. Nothing crazy, but yeah, slight 19-20 basis point pullback here from the market. So thank you so much, everyone. I really appreciate you all for joining. Hopefully this was helpful. EK, thank you for all the free knowledge. I'm curious, where did you learn all of this from? Was it self-taught or do you go to school? So I have a degree in finance. I went to school for finance and learned a lot of the fundamental analysis and macroeconomics from school, and then technical analysis mostly from books, trading, and making my own mistakes over the years. So, but I think it's important to have a holistic overview of the markets. Kind of having an understanding on fundamentals, technicals, and macros kind of helps you better connect the dots and better make sense of what's going on in the market. If you're simply looking at technicals, then you may not have an idea on what's overvalued, undervalued, what macro, what interest rates, how the dollar index, how the yields are playing a role with those technicals. So I think having an understanding on all three can really put you ahead of the masses of the crowd. So thank you so much for joining. Again, if you want to join our Patreon Discord, link's going to be down below. We'd love to have you on board. I'm just going to put that HTTPS. So feel free to join if you want. It's going to be just patreon.com/moneyvest. Link's going to be down below in the description. And I've also put it in the chat. And as always, happy investing. I'll see you all in the next video.